This was an analysis from yesterday, and if you haven't seen this analysis yet, I would recommend that you go ahead and check it out. There are a few things, or more than a few things, that I brought up yesterday in this analysis. So I will leave you to go around and check for this, and just you know take a look and see what this might have meant to you. So I will go ahead and continue from here with today's analysis on S&P 500, or SPX, but specifically we're going to be taking a look at what kind of plays you might want to consider moving forward as far as SPX is concerned. So let's move back to SPX itself and take a look at what's going on. These are the key level actually which I drew today, if I am not mistaken. If I pull this back to the 15-minute chart, yes, these are the key levels that I drew today. So this is the top red one is indicating the resistance level for the daily high, and the bottom red, which I should repaint a different color, is indicating a support level. Certainly should have been actually green so that we know that it's what it is. So it's indicating support level, and I am going to go ahead and go back to the 4-hour chart first, and then we'll come back to these levels later after we have talked about 4-hour chart for a moment here. You might have noticed that on my analysis from last night, there were a few key levels that we drew, and those key levels, I'm gonna draw it as a zone. Okay, I'm gonna draw it as a zone, and for now, let's get rid of that first. Well, not getting rid of, but let's move it a little bit further somewhere. Um, Actually, let's get rid of it. We'll redraw this later. Um, so there are a few key levels here that we need to consider, and first of all, let's consider these three or four red candles up here towards the previous high from July 15th. So let's just grab, since this is a consolidation zone, let's just grab this with a tall wick actually. I know those who knows how to draw fair value, fair value gap or fair gap value, or whichever way you want to call it, knows how to draw this better. But we're just gonna handle it this way for now. So you pick a candle of three runs or three candles of the same kind in a row, and then you draw a line, or you draw a zone in between the top of the second candle to the bottom of the third candle. But that's not what we did here. Considering that this is a consolidation zone, I just picked the second candle in a run, and I suddenly um, just drew the zone above, the wick, around the wick, the top and the bottom wick. So that's what we will use as our zone. So we have that zone there, and in addition to that, let's say we have this level here. Okay, we have this level here, but let's not consider this level as it is, since we already see what is going up there. But let's assume we never saw what that is. Okay, we would consider this bull run, and then we'll consider the next candle, and let's draw a zone around the next candle. Okay, what that would mean is that we would have this running from here to there, and then we'll expand that over. Okay, that becomes our second zone. And then let's do one more thing, the third zone. Let's consider our third zone. Let's If we consider this level right around here, we have three runs. We have the first run right here, second, third. Let's draw a zone around that, um, just like that. Remember here, my drawing, I'm just taking the first candle all the way and crossing it down. There's this, if you notice, this is which is outside the zone, and this is what throws most of the option traders out, because someone will go in. Let's actually make this a little complete. someone will go in and then set their trade, set their stop loss before below the previous lower low, and of course before this green, the lower low was this red right here, which I am painting yellow or rather orange. This was a lower low. You set your stop loss right below this, and this kind of thing comes and sweeps it up. So that's what we call the liquidity zone, okay, or a liquidity run. We had a liquidity run on that, and those liquidity runs normally it's something you would not have to trust. Okay, in addition to those three levels we have just drawn, let's make some sense of let's try to help make some sense of this. Let's draw a trend line that captures some of the key points here. Okay, we have this level right here, which was a previous resistance level. We have this level of liquidity run, which is certainly our um, major resistance level, and then we have this level as well, which is also um, the middle one is not touching the trend line exactly, but it's close enough that we should consider it to be part of the part of the trend line. And then if you go down the line, you will see that this line actually does cross through various numerous other um, support and resistance levels. So let's go back to what seems to be our current of the day. Um, Mind you, let me do a little thing here. Actually, I don't like to use Ikanashi, but let me use Ikanashi for this and this review only. I will turn on my Ikanashi because I just want to visualize things in a little bit a different way. If we take a look at today, you will see that we did, according to the analysis from yesterday. In yesterday's analysis, we predicted that around here we will be starting to make a U-turn a little bit towards this zone right here. Okay, we will call this zone uh, 2. Let's call this zone 2. Okay, um, and then let's call the one below it. Let's call it zone 3. Okay, um, we have zone 3 right here, and of course you know where zone 1 is. Okay, let's just level off all of them. So from zone 1 to zone 2, that is our current support level. Zone 1 is our current support, a resistance level, not support. It's our current resistance level. So we are bouncing off from that, and of which that means that within that zone, if we break through that zone and go above it, we should have a clear bull run. But if since it's been rejected, we are bouncing off from that, and we should expect a few more moves towards this zone 2. And once we get into this zone 2, we should see a bounce, which is we should see some rejection here, and going back to retrace that previous level, and maybe breaking over that previous level of zone 1. And that's what we would expect this play to go like. So in any way, depending on how things are going, as of now, though, it's not that bad. As of now, if we take a look here, this one security called the volatility S&P 500 index, or some people, or I mean not some people, but it's also known as the VIX. We know now that the VIX is stabilizing around 1755 as of today. And what that means is that it means that we are likely to be seeing a period where the market might curiously or cautiously be optimistic, but still we should be alerted to a potential risk. We might have a clear move to one direction. We don't know yet, but all I know is that when the VIX increases, that means we have a bear. But if the VIX decreases, that means we have a bull. In case you never knew, there you have it. Anyhow, we do see that the VIX is starting to be bullish here. And when the VIX is bullish, you want to be cautious, because when the VIX is bullish, everything else has to be bearish. Well, not has to be bearish, but most of the things will be bearish, because that brings panic. Because we use this VIX, or the market uses the VIX as the fear of gauge, or the fear gauge. The higher the VIX, the higher the fear. The lower the VIX, the lower the fear. In case you didn't know, now you know. I'm not going to draw anything around this, candles, or lines or anything, or put any labels on this. But I just wanted to use that for letting you know what this how this translate to the rest of the securities. Um, in any case, if we take a closer look moving forward, let's get back to a 15-minute chart. My 15-minute chart will look a little different. I do have an indicator that I normally use a lot of times, but I'm not going to use it. Well, I will bring it out in a moment here. We do see that eh, in today's trading, we did hit that zone. We were in this zone maybe a day or two. Let's see, today here, right here is 14th, 15, 16. So this is worth about 8 days right here in total, if I'm to say. So we have this. We were here consolidating within this liquidity run zone here, and then we kind of picked that up right away, rejected that trend line, and started rolling up. So we have that showed up real nicely. But more importantly, let me turn on my indicators actually, so I can see. It might be a little messy, but I will explain everything within the time left, so that you have a better idea of everything else that's going on here. Um, so if you take a look here, I don't like to hide things around. I use what we call open range breakout, and in my strategy, according to my way of doing things, um, I normally, because I use the open range breakout, I normally weigh things differently. And if you look at this rectangle things, which is what I'm referring to, the open range breakout, this blue things, that those with narrower uh, height, and those with wider heights. Okay, those with a narrower height normally have a lot of strength, even though it's looking a little different to you right now. But those with a narrower height normally have, those with let me repeat myself. Let me repeat myself. Those with narrow height have a lot of strength. Those with wider height um, have a very low strength, and it's bad for non-trending days. In non-trending days, this is not a good thing. So let me first remove my drawings here, which turned out to be about 15 of them, and I'm going to turn back my candles to the regular candles, so that we're not being biased, you know and manipulating anything. So we do have the open range breakout here. If you have realized, or if you haven't realized, you should see that on my chart I do have that open range breakout. I have this yellow line, or the orange line here, and then I have a few signals which tells what to be done at what point of time. So uh, let's if we take an example at today. Today the day started right exactly here. You see that the open range breakout is just a slim blue line right here. This slim blue line really is just telling you that this is way too powerful, that one side has completely will completely, or might completely dominate the rest of the day. That's what narrow line says. It carries a lot of strength. If you remember me saying that narrow lines carries a lot of weight, and wider lines carries really, really less weight. With technical analysis that we have, and also the trend direction that we know the trend direction. We have some bit of technical analysis in place. We have a few indicators to help us overcome our fear, in addition to the fear that VIX brings, because VIX is, like I said, VIX is a fear gauge. Um, so in addition to overcome the VIX fear, we do have our indicators. Personally, I do have my indicators to trade options. I would have an indicator that I do have an indicator that tells me when to sell puts. I mean, when to buy puts or when to buy calls. So in this scenario or situation, in regards to today, we open the open range breakout on a 15-minute chart. We close below the open range breakout. The second candles close below this orange line, which is what I call, well, not just what I call, but it's the VWAP, just in case you're wondering what the orange line is. If you look for the VWAP, you should find what that, what that line is, or what VWAP is, which is value weighted average. I mean, value weighted average price. That's what the VWAP stands for. So we have that. We break below it. We get our buy signal for put options. We put our puts, straight away enter our puts there, and then just ride along. Okay. With that, we wait until we cross the previous we cross the previous price action area, and then we start thinking of taking profit, because this red line is previous day's price action area. This current red line here, which is extending still right over here, is today's most active session or most current price action. So we have that. So meaning today, I mean tomorrow, what we would expect is that if price close, I mean opens. Actually, I didn't mean to use that. I will delete it for a moment. So tomorrow, if price opens below this line, this green line, we're hoping to look for put opportunities. But also at the same time, if price opens above this line, we're looking for more call opportunities. But it's not always true, because there are other things, there are other factors that you might also want to consider. There are days that price will open above the previous day's high, but it necessarily doesn't mean that the day is going to be bullish. It's necessarily, sometimes it's just going to be bearish. And if you take a look at today as an example, yesterday's higher high was right here. Let's paint that a little bit different. Yesterday's price was right on this yellow line. We open above that. That necessarily did not mean we had to buy calls. But what really does help us decide is, if you have the open range breakout, you will decide on which side you closed to. If you close below the open range breakout and reconfirm it, you would go to that direction. But if you close above the open range breakout and reconfirm it, you would go to that direction. Certainly, there are a few other indicators you can use. Let's bring a few others on board here. Here, I have introduced the RSI, which all of you probably know, and I've introduced the Ikenashi momentum indicator. So these two together does a very powerful job. So, for example, today, let's draw a line on today's open. That blue line there. The blue straight line says 22.24. Today, the market opens right there. Everything was right above the zero line. By the zero line, I'm referring to this yellow line here, or this orange line. Only if I can draw a line here, a box here. This that I'm boxing inside that red thing. That is the zero line. And also, on the other hand, this is a zero line right here. Okay, those things with the red on it, those are zero lines. The market opens above the zero line, which is perfectly fine. We'll wait for our breakout of the open range breakout. The open range breakout closes below the candle closes below the open range breakout, and the next one breaks on the RSI, breaks below the zero line on the RSI, which is exactly right here. And when it breaks below or above the zero line, it will stay on that direction for a little bit without being interfered. So that broke below right there. and the momentum